I also spoke to the governor of the Bank of Israel and asked him, before President Trump temporarily rolled back tariffs, what the impact would be on Israel's economy. Prime Minister Benjamin Netanyahu was at the White House earlier this week, pushing President Trump to drop the 17% tariffs on Israel, which have now been moved down to 10%, along with most of America's trade partners. I spoke with Governor Amir Yaron in an exclusive interview about those levies. Listen in.
I would say the global economy right now is in turmoil. Uncertainty is exceptionally high. And frankly, not all the implications are clear, and that might be even an understatement. And we see sharp market declines, probably due to concerns about major decline in global trade. That would have implication for slower growth, et cetera, et cetera. The U.S. has used one formula across the board, which is related to trade surpluses or lack of for the U.S. And I think we are going to be in a pool of countries that negotiate that. We are going to work in a way, the government here is going to work on ways to essentially reduce barriers and reduce that trade surplus that Israel has, but to find policies that mitigate the effects, the negative impact on Israel. I would say in general for the Israeli economy, given the fact that the global implications are for slower growth, reduction in global trade, those definitely will impact Israel. But I think Israel will be impacted somewhat more moderate than other nations, basically because our exports are not primarily, they're in the services more than in the goods. They are less exposed to tariffs. That's point number one. Point number two, we've been coping with shock. The Israeli economy has been coping for shocks and is sort of agile and resilient and knows how to deal with those.
I have to ask as well, your most recent forecast also assumes the resumption of fighting in Gaza won't extend beyond the second quarter of 2025. What's that based on?
Well, this is our ongoing assumption that basically the military involvement in Gaza is on the level that it is right now. We also have a scenario inside our forecast that escalates that to a much higher level of intensity, and that is primarily from an economic perspective. It comes in primarily in the form of reserves not working and going into Gaza. That's purely from an economic perspective. Obviously, we want the hostages to be back, and we hope there is security and hopefully stability and tranquility at the end of this process. But from an economic perspective, we assume basically 2 full more quarters of much higher intensity in terms of military activity there. And that implies, again, another deduction of 0.5% of GDP in 2025, higher risk premium. And again, because it impacts our labor market, again, higher inflation because we have shorter supply. In other words, excess demand and supply constraints are getting farther away.